Hi, good morning, everyone. This is Richard speaking, transport analyst. So today we are starting the webinar now. Usual disclaimer, Perion Networks, Yong Kaizen here to present this. So we move on. Okay, so I'll be speaking on Cogent Holdings, which we initiated coverage on last week on Friday. The report is available on Poem's platform. So agenda for today, go through the company snapshot, background, give you some details on the business segments, and then I'll talk a bit on their new warehouse, the Cogent One Logistics Hub, and then have talk on the investment thesis, investment merits, risk, brief sector outlook, and then wrap up with the conclusion. So previous close last Friday was 36 cents. We have a target price of 47 cents with a buy rating. The 52-week range for Cogent is between 20 cents and 49 cents. And it has a market capitalization of about 177 million Singapore dollars. So this is the one-year price chart. You can see the high is here. So company background for Cogent is that it's a leading provider of integrated logistics services in Singapore and has an operating history of over 30 years. It offers a range of logistics services categorized across 4 core business segments. It was listed on the main board of the Singapore Exchange in February 2010. So the 4 core business segments are transportation management services, warehousing and container depot management services, automotive logistics management services, and finally property management, which is their latest foray into the grandstand. So for the transportation management services, you can see here, this is a slide from the company. This is it shows that it says that they have a fleet of more than 100 prime movers and 400 trailers, and they also have one of the largest container depot in Singapore, and is one of the few licensed warehouse and chemical warehouse operators as well. For their automotive logistics management services, they are dealing with the import of new cars and export of the old cars. And lastly, property management, they are the developer and manager of the grandstand. I'll now go into further details in each of the 4 core businesses. So transportation management services, they offer the trucking service, transporting laden and unladen containers between the port, warehouses, container depot, and other destinations specified by their clients. So the flow of the work is that when a ship arrives at the port, the laden containers are unloaded, and then so Cogent's vehicles will bring the laden containers out from the port to the warehouses to be unloaded. And then after that, the unladen container will be brought to the container depot. And then the flow goes the other way around. When they need the empty container, the trailer will collect the unladen container from the container depot, bring it to the warehouse, and then at the warehouse it will be filled, and then finally it will be brought to the port. The other business segment, the other service that Cogent offers is dry hubbing, which is the management of transportation and inventory of laden containers at dedicated storage facilities pending shipment. So that's quite a mouthful, but what it actually means is that when their clients have a large shipment of goods that needs to be shipped, they can't start packing the containers at the last minute, so they need to start filling up the containers, and in the meantime the laden containers have to be stored somewhere. So this is what dry hubbing is essentially the storing and consolidation of a large shipment of containers at an open yard before the containers are being brought to the port. So this service by Cogent is available on mainland Singapore and on Jurong Island. And also part of this business segment is the transportation of petroleum and chemical products from Jurong Island. And Cogent also provides transportation services for the oil and gas industry, where they move the equipment that's used in the construction of oil rigs and they also transport ISO tanks and raw materials such as steel bars. Moving on to the next business segment, which is warehousing and container depot management services. For warehousing, apart from storing general goods, Cogent is also licensed to store chemicals, hazardous and flammable materials. And it's also a licensed warehouse. What this means is that they are allowed to store dutiable goods. So dutiable goods will arise through transshipment, consolidation, and deconsolidation. Transshipment is whereby the goods are passing through Singapore and en route to a final destination, which isn't Singapore. Consolidation is where these dutiable goods are passing through Singapore, but they are not being exported into Singapore, but they are awaiting consolidation with other goods to be sent to a final destination outside of Singapore. Lastly, deconsolidation is where the dutiable goods come in a big shipment and some of it is actually imported into Singapore, but the remaining ones are kept in the warehouse pending shipment out of Singapore. Other value-add services for this business segment is inventory management, loading and unloading of the goods, packing, palletization, forklifting, and drumming. Moving on to the container depot. The container depot is currently one of the largest in Singapore with a capacity of 20,000 TEUs. What happens there is basically an open yard where the unladen containers which are owned by the shipping lines are stored there until they are required. In addition to just storage, Cogent also does the repair, maintenance, and refurbishment of the containers. Their existing container depot will be shifted to the rooftop of the new Cogent One Logistics Hub, and we're expecting the rental expense for this to be greatly reduced. Next is the automotive logistics management services. So it involves the processing, transportation, and storage of motor vehicles being imported into Singapore. What Cogent offers is a seamless service of port and customs clearance, vehicular transportation, warehousing, and delivery. This integrated service eliminates unnecessary transitions between different operators, and it's an efficient and cost-effective service to their customers. So their customers, examples of their customers are Borneo Motors and Mazda. In addition to importing vehicles, Cogent is also licensed by Singapore Customs to store dutiable motor vehicles and to operate in the export processing zone. The export processing zone is where deregistered vehicles are being exported out of Singapore. Cogent also assists LTA in the repossession of cars with outstanding road taxes and the impounding of illegally modified cars, and also helps the Singapore Police Force at the removal of accident vehicles. Lastly is the fourth business segment for Cogent, property management services, which comes under a wholly owned subsidiary of Cogent, Cogent Land Capital Private Limited, CLC. So CLC is actually the developer and manager of the grandstand, which was formerly known as the Turf Club. The redevelopment of the grandstand was completed in 2012, and it's now a 1 million square foot property with a mix of F&B outlets and kids and family-oriented services. The grandstand also houses one of the largest used car marts in Singapore with more than 140 showrooms. This complements Cogent's automotive logistics business in the shipping of cars to and out from the showrooms. This property management service also provides Cogent with a stable recurring revenue from the leases. Now I'll move on to talk about the Cogent One Logistics Hub, which is their new warehouse which will be completed by the end of this year. So the new warehouse is a modern and superior design. It has a GFA of 1.6 million square feet. For perspective, it's actually bigger than Vivo City. Vivo City has a GFA of 1.5 million square feet. So their design has, they have registered patents in Singapore, Europe and China for their unique design of having the container depot on the roof top of the warehouse. The warehouse also has 2 independent vehicular ramps for warehouse and container depot, and is also licensed to store NA controlled materials and flammable materials. The Cogent 1 logistics hub is strategically located. It is within 3.5 kilometers to Jurong Port and Jurong Island, and is less than 30 minutes drive to Pasir Panjang Terminal. It is in close proximity to the future Tuas Megaport and Pasir Panjang future developments. It also has instant access to the AYE, Jalan Buroh, and Pioneer Road. The other feature of the new logistics hub is the multi-level warehouse. First and second story houses the flammable material warehouse and the NEA controlled warehouses. The third and fourth story of the warehouse are for general goods. Sixth story is for admin and inspection area for unladen containers. And on the ground floor, they also have some open space which they can use for their dry hubbing service. The container depot is integrated to the warehouse. The container depot is on the rooftop and it will have a capacity of 16,000 TEUs. They will continue to offer the same set of services, which is washing, repair and maintenance of the containers. Investment thesis for Cogent is that consolidation of operations from various warehouses and the container depot to Cogent 1 logistics hub will result in a reduction in rental expense, while at the same time increasing their warehouse space. They will see marginally higher net operating costs arising from the higher depreciation of the new warehouse. We see that the consolidation will be in stages, starting the second half of FY14, which started in July this year when they did not renew the lease for one of their warehouses, and finally the final and consolidation will be until second half of FY15, where they stop leasing their existing land for the container depot. So some financial effect will be seen from second half of this FY, but the full effect from all their consolidation will be seen from first half of FY16. So that's why we say that this is for investors with a long-term view, and where they choose to bite the bullet now and ride through the transition in FY15. And then they'll see that the operations will be streamlined during FY15 and normalized into FY16. So investment merits for Cogent is a vertically integrated business model. They have their service spans the supply chain from transportation and container depot and warehousing. As mentioned earlier, the new logistics hub is a modern and superior design and is strategically located. So for design-wise, it's a ramp-up. This is in comparison to other older warehouses where they have a cargo lift instead. So for ramp-up design, the prime mover actually can drive all the way up to the particular level where the warehouse is located, and then the goods can be unloaded into the warehouse at that level. In comparison with those older warehouse where they still use a cargo lift, the goods will be unloaded on the ground floor, and then all the tenants in the warehouse would actually be fighting for use over that one cargo lift or the number of cargo lifts that are available. So the other thing is that the rooftop container depot is integrated with the warehouse, and they have access to the dry hubbing facility that's on the ground floor from the open space that they have there, and it's strategically located. So we see that Cogent will have cost savings from consolidation of their operations from various sites. These sites are their warehouses at Chia Ping Road and the warehouse at Penjuru Lane and the container depot at Jalan Terusan. So Cogent also has a distinctive competitive advantage of being one of the few licensees allowed to store dangerous goods, and obviously this will have a higher margin for this business segment, and also their position to tap on trend for outsourcing of logistics to third-party logistics providers. And lastly, Cogent has some diversification and stable recurring income from their property management through their management of the grandstand. Okay, so then talk about the business, the risks now. So I group them into 4 categories. That's business risk, regulatory risk, liquidity risk, and information risk. So for business risk, what we see is that there's going to be a large supply pipeline of warehouse space in the next 2 years, 2015 and 2016. So this could put pressure on rental rates and occupancy for Cogent. Also, business risk will be their ability to retain and attract new customers. And currently, they have licenses from NEA or SCDF to store the dangerous materials. So if they lose this license, then they will not be able to store the dangerous and hazardous materials. But this would probably be unlikely, as the licenses are granted based on the design of the warehouse. So once they have already fulfilled the design of the warehouse, then there shouldn't be any reason why their license will not be renewed by NEA or SCDF. And lastly is their master lease agreement for the grandstand. So as mentioned, they also store the hazardous materials, dangerous goods, chemicals, and flammables. So this also poses some risk. Next is the regulatory risk. So unfavorable government policy on land use and car population can affect their warehousing business and their automotive logistics business segment. Liquidity risks would be the free float. They have a low free float of about 15.7% and a 30-day average volume of 208 shares traded. 208,000 shares traded, sorry. And lastly is information risk. It's a small cap company, so disclosure of information is usually not as detailed as the blue chips. And lastly, there's also a lack of market consensus due to the absence of extensive analyst coverage. So we now move on to a short outlook, summarized outlook for warehousing space sector. So the warehousing space has seen a healthy historic average occupancy. It was at 91% occupancy in 2013. But as mentioned earlier, there's a supply pipeline of warehouse space, and so the next 2 years could be quite challenging for warehouse operators. This could put pressure on occupancy and rental rates, but for Cogent is slightly different because they have a new warehouse, and they shouldn't be at the bottom of the range for the sector. We have seen that actually rental has stabilized. It dipped in the first quarter of this year, but it has held constant through the 3 quarters, first quarter to third quarter of this year. And so Cogent, we believe that Cogent should be at the top of every potential tenants list. Although the whole sector is affected, but the Cogent One Logistics Hub is a modern facility with a ramp-up design compared to Cargo Lift, and has better operating efficiency from its integrated design, whereby there's container depot, warehouse, and dry hubbing all at one site. So we think that Cogent should fare better than the sector average and should be able to maintain healthy occupancy and rental rates nearer to the higher end of the sector's range. So some other information: recent insider transactions in the last 12 months. Deputy CEO bought some shares at 37 cents, and about a year ago CEO bought some at a price of 21 cents. So for dividends, Cogent doesn't have a formal dividend policy. Final dividend is declared in the second half when the full year is reported, usually in late February, and then the dividend will be paid out in early May. So last FY's dividend was 1.26 cents, representing about 40% payout, and previous year was 0.2 cents, 12.3 payout. We are currently estimating about 1.3 cents dividend for this year, which is slightly higher than FY13 because they have some exceptional gain from disposal of a property, so they may choose to return some of the gains to shareholders through the dividend. So to conclude investment actions, we believe that investors who are interested in Cogent should take a long-term view as the consolidation of operations will be in stages and the growth in earnings, big growth in earnings to come in FY16. So with that, we issue a buy rating on Cogent with DCF derived target price of 47 cents. This is an implied forward PE of 15 times of FY15 earnings. And last week, Cogent closed at 36 cents. So this gives a estimated 31% upside from last close. So with that, we come to the conclusion of the presentation. We welcome you to ask questions. Our team is ready to answer your questions. Hi, there's currently no questions. Are there any questions from anyone? Hi, we still don't see any questions from the webinar participants. Do you all have any questions? Hi, there's a question on who are the main competitors of Cogent. So for their transportation management services, you can refer to page 5 of the report. So Cogent's closest competitor is actually Po Tiong Chun, the listed peer. And then for the the listed peers, closest competitors are Po Tiong Chun, CWT, and Vibrant. There are no listed peers for the container depot business, but the competitors are OCWS Logistics, Incong Holdings, and Allied Container Group. You can find this in our report. There's a question on whether oil price effect has been taken into account for the target price for Cogent. If you refer to the report, actually, fuel isn't one of the major cost components for Cogent. It's only about 9%. Their largest cost component is actually rental, rental for their lease spaces. So that's why this new Cogent One Logistics Hub is a good development for them because they're actually going to eliminate a lot of their rental expenses and then transfer it into a depreciation expense which will be fixed across the years instead of seeing rental escalation. And moreover, with the integration of various warehouses and the container depot piled one on top of the other in a multi-story building, they're actually going to get more space for less cost. There's a question for possibility for Cogent to sponsor industrial REIT. Um, we don't. We are not speculating on any industrial REIT sponsor at the moment for Cogent. There's a question on what's the CAGR for the company's revenue. I think to look at the company's revenue CAGR is not really quite a good way of looking at it because they recently had their addition of the grandstand to their revenue contribution, so it's not comparable that way. Okay, since there are no more questions, we'll end the webinar here today. Do tune in again next week.